Hey, good morning, David. Yeah, respondents expect the Fed to hike by 50 basis points this week and add another 75 through early next year. But there's a suggestion in this survey that the worst may already be priced in to stocks and to bonds. Take a look. The S&P is seen closing the year around the current level and rising about 12% next year to 44.18. That's a pretty optimistic outlook amid the more rate hikes that are suggested. The important part of the result may be that respondents haven't meaningfully marked down their outlook anymore. You can see that in our CNBC risk-reward ratio. We ask about the chance of a 10% increase or decrease in stocks in the next 6 months. The ratio fell to minus 16, but mostly because respondents don't see much chance of a upside surprise. They only raised a bit the odds of a sharp decline from 48% to 51%. Respondents also don't expect much movement in the 10-year, with rates rising only to 367 to finish up the year from the current level of around 356 and ending next year right around where it was, 360. 91% of those surveyed believe inflation has peaked. So the problem facing the Fed is not believed to be getting at least worse from here. The main question is whether the Fed's fight against inflation ends up in a recession. The probability of recession next year put at 61%, about where it's been. But there is a small group, a bit bigger than the last survey, forecasting a soft landing. It's not the base case in the survey. The good news here is that the base case hasn't gotten worse. And obviously, guys, tomorrow the inflation report could change all of this.
Yes, it's going to be such a busy week, Steve. In light of that, the fact that the Fed and Chair Powell in particular has continued to be very hawkish and continues to hammer home this message of higher rates for longer versus the fact that the market seems to be pricing in rate cuts as soon as next year. I mean, what would it actually take for the Fed to make a move like that in this environment?
I think it would take a lot. I think that, and by the way, we have a survey in this question. I'll be talking about this in the 1 o'clock hour. The results are that the respondents do not see the Fed responding to a moderate recession if inflation remains high. I think that's a key part of what Powell wants the markets and forecasters to understand. It's a big part of their forward guidance that they are not going to flinch by a moderate downturn in the economy, assuming inflation remains high. If you still have high inflation and you have negative growth, the expectation is that the Fed won't raise anymore, but that it's not going to cut. And Morgan, when you think about the outlook for stocks and the economy, that's a pretty negative mark right there, that the Fed will not be coming to the rescue of an economy that's contracting if inflation is still a problem.